The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, we saw the wheat market push its way lower on Wednesday. That pulled corn lower as well. Soybeans were a little more firm. Federal Reserve also came out on Wednesday with their latest policy update and an as expected 25 basis point rate hike. We're going to talk about all of that and more here as we look big picture at this market trade after Wednesday's session. We welcome in Mike Zuzolo with Global Commodity Analytics joining us here today. Mike, always good to catch up with you. I hope your week is going well so far, with especially with all the news items being thrown at us here in this trade, Mike.
Yeah, air conditioner still running as we head towards the century mark for high temperatures, so keep your fingers crossed.
Yeah, definitely keep your fingers crossed. I'm seeing a few tweets here and there, some farmers saying we're done when it comes to this crop with 100-degree temps and 20-mile-an-hour winds, and that could be something we could talk about a little bit more here as we go on with the show today. But I want to start with the Federal Reserve and just the economic picture. 25 basis point rate hike as expected. Fed Chair Jerome Powell's comments here this afternoon. Didn't see anything that surprised me. What's your take on what the Fed said on Wednesday?
No, I agree. I think that the market was expecting what they got. I think that the trade, much like the cattle report, the inventory numbers that came out last week, we're hitting some historic levels. And in terms of the rate hike, we are now at a 22-year high in the rates. And you can see that in this 2-year U.S. Treasury bond yield chart, where we have been able to get back up above 5% once again this month and get back up towards those 2007, 2008 highs. I think the fact that the USDA taking the cattle inventory numbers down so dramatically, and the trade having expectations of that, Jesse, much is the same, I think, as far as where we go from here, with the Federal Reserve now being known that they're going to keep with their 2% inflation target goal. Do we now break through that purple support line on this monthly chart? And if we would, that would indicate that the bond yields, the real interest rates in the market, so to speak, would be putting in a double top. And if that would be the case, then I would be looking for the US dollar to find a top with that market, and the dollar to be much less of a headwind against us and put us on track, the final track, for us to pick up some export business and become competitive once again. So framing everything out today, it's not so much what the Fed said, it's how the market now reacts, since we, as you say, did not get any surprises.
Yeah, no surprises. And to your point, looking for some of that export business, we really could use a bump in our demand somehow, make us competitive on that world stage. On the wheat picture, let's jump over there and let's start our grain talk with wheat. Obviously, a couple big down days. I made the comment to you before we went on air. It reminds me of when Russia first invaded Ukraine. A lot of up, a lot of down, very volatile markets, back and forth. And just your thoughts, what you're seeing in wheat, whether we're talking U.S. here or the correlation to EU milling wheat as well, Mike.
Yeah, this is a neat chart from a standpoint of price projections and why I feel the way I do. And I saw where the International Monetary Fund came out this week and said wheat prices globally could jump 15%. I've been talking about the $9 level, a retracement level in soft red wheat, back to $9 in the futures market. And that's partially due to stocks to use ratios, partially due to this chart. And you notice the blue vertical line, dotted line there, back from last year. This is where the Russian grain deal was initially signed, and we were trading an EU milling wheat futures equivalent in dollars in Paris at about 9 to 9.50 a bushel. I think we should be back at that price level now that the grain deal has been no longer extended and has now in fact expired, and the hostilities have increased in targeted grains specifically. That does not help explain why we were down almost 50 cents today in the hard red wheat and 40 plus in the soft red wheat in Chicago, except, Jesse, that when you look at this weekly chart in Paris of wheat, it's now down on the week. And the reason I think that is because unlike the rice market, which has seen a big jump in end users going and running for cover and extending their buying and their needs because of India's rice ban, export ban last week, we're not seeing that type of follow through in the physical wheat market in Europe. And that's in part because of this new term that the European Union has kind of resurrected, solidarity lanes of shipping grain out of Ukraine through non-Black Sea means. And it's very expensive to do, very hard logistically to do, very hard politically to do. But my bottom line point is that the French price of wheat in the cash market has risen about $40 a ton to about $265 a ton. Last year at this time, it was $350 a ton, and we had more ample supply. So I think we've gotten to the point where the funds have been able to sell this market off because the cash hasn't followed the futures higher, right on top of what you were talking about, much like what we saw in the past.
Well, and one other thing I'll throw at you as well here with this wheat market, it felt like some of the strength the last couple of days before we started selling off was maybe tied to not necessarily the here and now, but next year, the year after. If Russia continues to bomb export terminals in Ukraine, how long would it take for Ukraine to have those rebuilt? So I think that was more what the trade was picking up on the last couple of days. And now that those attacks have stopped for at least, the last 48 hours or so, that seems to be another reason as to some of the selling here, Mike.
Yeah, I agree. I think they are kind of whistling past the graveyard because the bombings have stopped, hoping that the Russians will just automatically come back into the grain deal. We still, at the end of 23-24, are going to have a 7 to 8 year low in world wheat stocks. We can't get around that with or without the Black Sea grain deal. Trade just can't deal with that yet.
Well, and you and I talk a lot about wheat being the leader, whether it's up or down, and corn obviously moving lower with wheat on Wednesday. And I'm starting to see some more of this chatter across social media, and take that for what it's worth. But some farmers here in the U.S. saying our corn crop is done for with 100-degree temperatures here this week, and 20, 30 mile an hour winds just drying things out that have already been stressed. I don't know how much of that you are hearing yet, but let's talk about corn here. Should we be concerned at this point here in the growing season for corn, Mike?
Yes, very much so. And I think, again, we have a disconnect here, and in large part because of the wheat. In fact, I talked to an Iowa client late yesterday afternoon, and he said, I just can't sell any more corn at this point in the physical market because I just don't know what I'm going to have. That's saying something, and that's registering on a lot of these crop vegetative density maps, these evapotranspiration maps and indices. A lot of the modeling data that I use is obviously satellite based. This is another type of modeling data that I purchase, and it's the Northern Hemisphere Corn Drought Stress Index. It's usually just going to be the United States, China, and Romania because they are the big power players on the export market when it comes to the Northern Hemisphere. And what I like about this is that it gives you a range of where we've been in the last 20 or so years. It gives you a range on the 5-year average. That's the blue area. And then you have the orange area that is last year. And then obviously this year is the red line. And we are neck and neck with last year's crop data in terms of drought stress in the Northern Hemisphere. And this is important because China is having a substantially dry year again. I think, again, the trade is kind of slow walking, wanting to put premium back in the corn. But all I can say, Jesse, is when I look at everything from a standpoint of how I come up with my yield model and how I come up with the national yield for the United States, it's still very hard for me to get to 173.3 in corn, which was last year's number. And the crop conditions Monday afternoon kind of verified the idea that we may not even get towards anything better than 2019. And that goes to your point about losing the crop right here, right now. We've got 6 of the 12 major states running neck and neck with good to excellent conditions with 2019. That put the national number right with 2019. And 2019 was a 167.5 yield year. So I think a lot still has to be written about this chapter in this book of the next 30 days, because we are in deep silk and we're filling in a lot of areas.
Well, and to your point, talking to your Iowa client there, Mike, he doesn't want to make any more physical sales, and I understand that. For someone who maybe hasn't really done anything, I mean, I know that you can do more than just a physical cash sale. There's so many different tools in the toolbox, so to speak. So it's not all doom and gloom. You have tools at your disposal, right, Mike?
Yeah, exactly. And, that's where a lot of times when I recommend a floor position, which would be considered a bought put, because futures is not a floor. Futures has margin, so it can push you in and out of trades, and futures have unlimited risk. But if I recommend a floor position like a bought put, it's usually on the low end of the market, worrying that we can break into a whole nother level of downside or go and retest the major lows. And there are gaps below this market in corn. There are gaps below this market in some other in other grains and oil seeds. And so looking at a September or a December corn put may not be a bad idea, depending on where you're at, what your crop insurance levels are, and, on an individual basis. I'm not buying any corn puts, generally speaking, right now, Jesse. I have waited on getting anything new in terms of hedges in place for about 3 weeks. I still want to see if this wheat market is not a long-term buy.
We are having a conversation today with Mike Zuzolo of Global Commodity Analytics. Mike, let's move over to soybeans, and that'll help us segue into livestock as well. Soybean trade was pretty firm on Wednesday. In fact, August beans had a heck of a close on Wednesday there in the front month. I know we got some soybean sales to unknown destinations announced Wednesday morning, and I know the fundamentals are a bit tighter under the soybean market. I mean, what's your take on how the soy complex performed on Wednesday? Bean meal beans had a pretty solid day in the face of selling.
Yeah, very nice physical market. And I think that's the clear distinction in the soybeans, having the beans and the corn corrected, the bean corn ratio getting down to a multi-month low earlier this week and last week, Jesse. That really set us up for some short covering if we saw demand again in soybeans. I think what we're seeing in the soybean complex is multifold here, and it goes back to the Chinese economy. The expectation, I think, that the Chinese economy is bottoming. The Chinese will stimulate their economy. The hog market's been able to rally very nicely, and that's on expectations that maybe their price low is in because their production low is in. I think also the fact that we saw those export sales to unknown destinations today really does give us the big D word, demand, and that brought the market back in. Probably the most important feature, though, when it comes to the investment funds is the U.S. dollar made a new 13-month low against the Brazilian real. And I think that really made a big splash in the market from an investment standpoint, especially given this agro currency, this agro dollar that the Argentines are talking about putting into place, really focusing more upon corn and wheat, maybe a little bit of meal, but it seems like the soy complex is not looking very negative when it comes to Argentine competition at this point, obviously because they didn't have a crop last year. So the agro dollar, that's kind of a missing link or kind of an unknown X factor in terms of what role it's playing in the corn and wheat negativity, maybe creating an environment for the funds to jump in there and buy beans and sell grains.
Well, Mike, you mentioned hogs tied in with beans there, and I love when you talk about the pork and bean trade. And, I look at this chart you provided me, and boy, beans and hog futures lead months seem like they're lining back up together a little bit here, Mike.
Yeah, the correlation's coming back after having a pretty rough first quarter of 2023. And then second quarter, they crossed and finally came back together. Now, as we get into the later part of July, we're starting to see for the better part of a month and a half, we've been able to really find some positive price relationship between the two. I think, again, this is the Chinese news coming in. I think the stimulus expectation is getting priced into these two asset markets. I think it also goes back to the hog market has had the belly trade to help it this past month. The soy market has had the bean oil trade to help it this month. And now it seems like the baton's being handed off to the meal market. And so that in that respect, the product markets are coming in and supporting these, major soy and hog complexes.
As well, cold storage report was out Tuesday. Seemed like that was fairly neutral to the market overall. Would you agree with that, Mike?
Yeah, I would, and I think coming on the back end of that biannual cattle inventory report, where we've got 52-year lows and some of the inventory numbers now, that's only going to help the hogs as well, as is that BLT seasonal. We've got a situation where the belly market, wholesale market is running to upwards of $225. That's carrying that cutout value upwards of $117, $120 in the pork cutout. Typically, you can get to $120 hogs in the cash index when you get that type of rally this time of year. And that's important because the correlation, the price relationship, again, between cattle and lean hogs on a 10-week basis, we've seen a real shift. We've gone from April of this year from a negative 70 percentage point relationship in lead month futures over a 10-week basis to over an 80% positive relationship. And so it looks like we're kind of in a sweet spot after those cattle inventory numbers, cold storage numbers. If the hogs hold up here and maybe want to step on the gas one more time before the last holiday and then summer, and that BLT seasonal kind of eclipses here the next week or two, it could really help the cattle market. And I think these are great pricing opportunities.
Well, Mike, as well, I should ask you on the energy side here, real quick today. Crude oil, I know we've been making fresh new highs. We broke through the 200-day moving average earlier this week. You're getting crude back up around $80 a barrel. Supportive, not supportive? What are you watching with that market right now?
I think it's very supportive, Jesse. I think the crude, the copper, and the wheat should be our Chinese markets other than the soy and the hogs. And I would be looking for, if the crude oil stands up against this Fed update, the copper to come around, and then that to bring the wheat around, kind of a 1, 2, 3 domino effect. If I don't see that, then something's going amiss here in the fundamentals that we just can't see yet.
Mike, great thoughts as always. And before we let you go and wrap it up, final thoughts, anything you want to share? Obviously, a lot going on impacting these markets right now.
I think deep down the market knows there's a global El Nino phenomenon going on. I can't believe that they are just done with that at this point, Jesse. So just keep your ear to the ground, so to speak, on that, because it could bring back a very strong wave of buying now that we're through some of these macro headwind potentials.
And of course, do your best to manage your risk and the risk of trading futures and options. You know the line better than I do, Mike. But
substantial risk of loss and hypothetical performance is not indicative of future results.
See, I knew you knew it. I need to learn that off the top of my head. Mike, if folks want to reach out to you, get some great advice, check out your analysis online, how could they do that, Mike?
Globalcomresearch.com is the best place to go. You can look at our product services brochure, get a 2-week free trial. It's globalcom with 2 M's research.com, or pick up the phone if you have something specific. I've had a lot more call-ins. I really welcome that, especially after the close.
Mike Zuzolo, Global Commodity Analytics. It was always a pleasure, sir. Thanks for joining us this week, and we will talk to you next week.
Thanks, Jesse. Appreciate you having me.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.